Welcome to Taking Stock. I'm Amanda Lang. Coming up in the show, there's help for the steel industry, but is it enough amidst a trade war? And is artificial intelligence coming for your job? The more you studied, the worse off you might be. Plus, retail is still struggling to find its footing. We'll dig in. That's all ahead. First, for the week that was in business, it's time for the briefs. Inflation in Canada was 1.9% in June, high enough that most economists think the Bank of Canada will not lower interest rates in a couple of weeks. Even as gas prices fell, they didn't fall steeply enough to offset gains in car and furniture prices. A key measure of core inflation is still running above 3%, outside the bank's target. Strong jobs data recently also weakens the case for rate cuts. Prime Minister Carney said this week that any new trade deal with the U.S. would likely include some form of tariffs on goods as trade negotiations continue ahead of a now August 1st deadline. If a deal isn't struck by then, President Trump has threatened to levy 35% tariffs on Canada and on other countries. The federal government announced new quotas on steel imports. Steel and aluminum from Canada continue to face U.S. tariffs as high as 50%. Now, imported steel above certain levels will be tariffed at 50% as well. Ottawa will spend $70 million on training and income supports for workers and provide more than $1 billion in supports to the steel industry. The pace of sales picked up in June, with national activity up 3.5% from last year and prices falling slightly. The national average home price was $691,000 in June, down from the year prior, but up slightly from May. Data from CREA suggests that home sales will fall 3% this year, compared to an April forecast that expected sales to be flat. 560 wildfires were burning across Canada this week, 155 of them considered out of control. Manitoba continued to be hard hit, and air quality alerts were issued for much of that province, as well as Ontario and Quebec. The city of Thompson, Manitoba, remained on an evacuation notice, with 13,000 people prepared to move. Google has signed a contract for $3 billion of hydropower from Brookfield Asset Management. The 20-year deal is the largest in the world and will source the power from 2 hydro projects in Pennsylvania. Google plans to invest $25 billion in data centers in Pennsylvania and neighboring states in the next few years. And those are your business briefs. We have new quotas on imported steel and help for workers displaced by the trade wars. Those are 2 of the steps Ottawa is taking to shore up Canada's steel producers. But is it enough? Michael Garcia is CEO of Algoma Steel. Thanks for being with us.
My pleasure, Amanda.
This help, of course, comes in the context of the Prime Minister saying there are likely to be some form of tariffs, Michael. So I wanted to start there. We're negotiating a deal. What can you live with as an industry if there is some form of tariff on the other side of a new trade agreement?
Well, it's hard to answer with one number. I think there's several pieces to this puzzle. There's obviously the tariff rate. There's whether it's announced as part of a ramp or part of a beginning of a further negotiation with a goal of getting the tariff rate down to a second level. Mm-hmm. And there's also the state of the domestic market and how fast the activities around building Canadian strong can pick up speed. So definitely we know that 50% is not a deal that works for Canada, as the Prime Minister has been alluding to. He wants a deal that works for Canada. It certainly doesn't work for Algoma Steel, but we are hopeful that a tariff rate that's significantly lower, although we acknowledge that it may not be zero, is something that we can see soon so that we can move forward with more clarity.
And of course, as you move forward, keeping the domestic industry strong does seem to be part of the approach here. That the whole procurement idea, buying Canadian, how quickly can that take effect? I mean, that's an important change. It's, I think, a welcome one to folks in the industry. How quickly do you start to see it show up?
We do welcome it, and I think it depends on the specific project. There are projects now, bridges, pipelines that can easily be built with Canadian steel. And the government has already declared an intention for that to happen. So I think those type of projects can be built quite easily. There's other projects that may have more complicated supply chains that aren't quite in place, or supply chains that have contracted over the years. I'm thinking of shipbuilding. So there's a lot of energy around shipbuilding, both in Ontario province and out in Vancouver. It's a capability that Canada used to have, but it's lost some of that capability in the recent past couple of decades. So the timing of that would have more to do with, can the fabricating and the shipbuilding enterprises stand themselves up and get going. The steel that they need is ready. We're ready to produce marine grade shipbuilding steel. We've done it in the past. We can easily do it going forward. So I think it really deals on a project by project basis, but I expect that a lot of it can happen sooner rather than later with the right leadership from the government, which they are providing.
Only about 30 seconds here, but can you also diversify away from that U.S. market? 90% of Canadian exported steel goes to the U.S. Can we do that differently?
That's our intention. When all this is kind of behind us and we have a more stable trading relationship, I don't necessarily want to get back to the old days where Algoma Steel shipped 60% of our steel to the U.S. I think Canada needs our steel going forward, and we want to be there, and we want the majority of our steel to go forward. It may take some investments to make maybe certain products of steel and certain forms of steel that we no longer make today, but we're ready to do that with the right support and alignment and understanding of the opportunity.
Michael, so good to have you. Appreciate your time.
Thanks, Amanda.
Michael Garcia is CEO of Algoma Steel. Coming up, the labor market faces huge disruption. How can we find the people and the skills we need to meet it? Stay with us. Welcome back. The job market in Canada is facing some transformational change, including, of course, the arrival of artificial intelligence. So is AI here to take your job? Here's what you need to know. Back in 2024, StatsCan studied the question of AI and jobs and determined that in 2021, 31% of employees of working age were highly exposed to job losses to AI. 29% were highly exposed but might be able to use AI in their jobs, and 40% of workers' jobs were not considered at risk from AI. Workers with more education were more likely to be at risk from disruption from the technology, but some of those professions will also be improved by it, including doctors, nurses, and teachers, while others could simply be displaced, including those in business, finance, and communications. Jobs that are considered at very low risk include welders or machine operators, carpenters and plumbers, and food and beverage servers. StatsCan found that while 83 to 90% of university-educated workers are in jobs likely to be affected by AI, more than half are in jobs that will be transformed but not replaced by the technology. Unsurprisingly, workers in the skilled trades were least likely to be exposed to an AI-related transformation, though the number is still 27%. AI is also expected to help solve some problems in Canada, like shrinking labor force and weak productivity. And even as AI displaces jobs, it can be a crucial tool in the labor market matching process, helping people find the jobs they're suited for. Even as we worry about how the labor market will be transformed, we are also worried about big skills gaps, existing and those that will come as this new technology drives change. Lisa Lalande is CEO of the Century Initiative. Thanks for being with us, Lisa.
Thank you very much for having me.
So immigration, of course, has been seen as one way to fill gaps. The current climate around immigration has shifted. We've seen a kind of a reversal of a move to more is better. Are we still prepared to bring in the labor that we desperately need in our labor market?
I would say that immigration is going to be essential to address our labor market needs. It's not going to be the silver bullet. You talked about AI, you talked about automation, and there's definitely some underfunding and training in that space. But I have to be clear that without immigration, we don't stand a chance. You mentioned some critical labor shortages. We have over 1 million shortages in healthcare, in construction, in manufacturing. We have looming shortages in green tech, in agrotech. And I would say that we need a workforce plan that looks at immigration as strategic immigration, as tied to our economic prosperity, so that we could actually better have immigration better align with our workforce needs of the future.
And we have seen some real progress on that front. Like the permanent residency program has been used in recent years to really match on the economic side. Will that continue quietly, or do we need a kind of a renewed commitment by this federal government to say, okay, maybe we won't do 500,000 people a year, but we are going to actually be very laser focused on bringing in the people that we need for the jobs that we have?
We need to be laser focused on bringing in the people that we need. I think we have had some successes, as you noted, with the permanent residency program, but our pulling back significantly on the international student side is going to actually cause some additional shortages, for example, in childcare and our ability to meet our labor force needs in childcare. Immigrants, for example, are disproportionately in those fields, and so what we've noticed and what we've tried to communicate over time is that we need a plan for immigration. And it's not just about growing for the number's sake. It's about really understanding where international students can play a role in also addressing our workforce needs. So it's about having or understanding our post-secondary institutions as being core to our workforce planning needs.
We put a real chill on that part of the market, Lisa, right at a time when we probably want to be attracting the best and the brightest in some of these new technologies. Do you think that will be reversed?
I hope so. I think that, given rhetoric that I'm seeing, we're concerned. But we do have a, once in a generation opportunity to seize what we're seeing in the United States, particularly with the talent wanting a safe haven. And I think this is where business can align itself, not just with government, but with post-secondary institutions. They have been hollowed out with the funding losses, not just from the loss of tuition, but also from, a lack of appropriate funding from governments. And so I think that we do have an opportunity, and we definitely need to seize it now before other countries do it.
And do we need new programs to target some of these very new categories, or do we have everything we need? We just need to go back to letting people in.
It's probably a combination of both. I think we need, obviously, greater investments in AI, in agri-tech. And I do, one aspect that's not actually thought of or talked about a lot, which I'll bring attention to, the philanthropic sector holds $125 billion in assets. They could be seen as a strategic partner in further developing agri-tech and partnering with First Nations and resource development, et cetera. So I do think that we have an opportunity to be more ambitious as a nation, and we should seize it.
Lisa, so good to have you. Appreciate your time.
Thank you.
Lisa Lalande is CEO of the Century Initiative. It's clear jobs are going to change fast in the months and years ahead, so can we change with them? Noel Baldwin is Executive Director of the Future Skills Center. Noel, thanks for being with us.
Great to be here.
So AI is top of mind for many people, and it feels as though that's going to move fast. But even when we look at things like the support the government's offering for displaced steelworkers, there are plenty of workers that need retraining. Easy to say, hard to do. How are we at that?
I mean, I think that Canada has strengths and weaknesses, like with everything. We have a really strong post-secondary education system and K-12 system that gives people a strong foundational skill base. Where I think we are still working on how to get better is, in a moment like this, how do we connect directly with a sector that's going through a transition to support workers to maintain skills they need for their next job? And how do we be proactive about that with something that's coming down the pipe like AI?
And of course, one of the interesting things about AI is we just ran through some of the data. Some jobs will be made better. So some people will need training to get better at AI and use it in their jobs. Other jobs will disappear altogether. Those are two very different kind of tracks. But do you feel as though we are equipped to handle both of them? And by we, I guess I mean every level. Organizations like yours, but also private companies and government.
Yeah, I mean, we're really focused on this like many people are right now. And one of the things we're seeing, for example, through a regular survey of Canadians that we do with partners at Diversity Institute and the Environics Institute, is that Canadians are already using AI in work, and in increasing numbers. Almost 4 out of 10 say that they're using it regularly at work, and they find it helps them to be more productive and creative. But what's interesting is very few of them have had any formal training, and also very few of them are doing it because they've been directed by their employer. And I think that's where there's a really important gap that we have to pay attention to, so that we don't take on a lot of the risk of the current suite of AI tools, where you need to be mindful of privacy and kind of what you're putting into the models, but also so that we get that productivity benefit, right? People need to be offered training in the context in which they're working to develop AI skills that'll really boost productivity.
You've been watching this kind of pattern of trying to retrain people for other jobs, not the jobs they were originally trained for a while. How easy is that to do? I mean, we've seen over time people who worked in one part of a factory training for the other part of the factory. This is a bit different, though, right? Now we're saying you were a steel worker and maybe you need to think about a job in a digital space. How possible is that for people?
I mean, I think it's very possible for people, but it does take some fairly thoughtful and considered approaches. One of the things that we've found in our work is it's really important to get as close to the ground where these transitions are happening as possible and get all or as many of the local actors who have a stake in it together, education and training providers, employers, and workers, so they kind of chart a path and everyone feels that they've got a stake in it. But the other thing that we can't control, and this is a bit tricky too, is that the wider economic conditions can also make a real difference, right? So boom and bust patterns in commodities, for example, right? When prices are low, people are more interested in training and thinking about the next stage in their career. When those prices go up, it becomes less of a priority. We really need some concerted effort with lots of people around the table, all orders of government, educational institutions, organizations like ours that are doing some of this research and then, the folks in these communities so that we actually can plan some of these things on a forward basis.
So good to have you, Noel. Appreciate your time.
Thanks, Amanda.
Noel Baldwin is Executive Director of the Future Skills Centre. Coming up, why does Canada insist on maintaining our system of supply management? That's still ahead. But first, specialty chip maker Nvidia got the green light to sell its chips to China again. Nvidia makes the high-speed, high-functioning chips that power artificial intelligence and got caught up in the trade war between the U.S. and China. Being cut off from the fast-growing market for AI in that country was a blow to the U.S.-based chip maker. Not that you'd know it from its stock price. Nvidia recently became the first company ever to be valued at $4 trillion. But we hear it's the first trillion. That's the hardest. We're back after this. Welcome back. When Hudsons Bay was closing its doors in Canada, it liquidated its store inventory. It's often one of the last steps on the way down. And for our next guest, that means when business is bad for some, it's good for them. Alex Hennick is president of AD Hennick and Associates. Alex, thanks for being with us.
Thank you for having me.
So there's this feeling, Hudsons Bay obviously seems like in some ways a long time coming, but there is this feeling that there's a traditional category of retailer that is just struggling now. Is that borne out by what you're seeing in the market?
Yeah, it's a different time. A lot of retailers, especially that old traditional retailer who doesn't adapt. It's a different world nowadays. People are not going to stores as much. And in general, everything's changing, what people are buying. And so I think it's just there's massive changes in terms of the retail landscape.
The process that you play a role in, which is the liquidation part, is that's not good news for a company in the sense that they're trying to get every dollar they can for debtors. But they obviously, you can raise a fair amount of money, I imagine. And in fact, there's extra inventory that can be sold in the process. Can you explain how that works?
Yeah. So, I mean, in terms of, using the Bay as an example, when you're running these store closing liquidation sales, you're utilizing whatever assets you have left in order to make as much money as possible so that you can pay back the creditors. Throughout this process, sometimes the liquidation companies will even add more inventory to the sale based on how much traffic and how many people are in the stores. So it is a great opportunity to mitigate, what is owed to the creditors.
In terms of how the market's shifting, I mean, as you say, it feels as though some of the traditional big box brick and mortar stores, the department store especially, is sort of going away. Are you seeing a kind of a concurrent strength in other categories that will make up for the loss of some of those retailers?
Yes and no. It's tough. Like people, I would say, are more reluctant to spend these days. They're spending more on things they need versus on things they want. There has been massive changes really since COVID. We've seen a big change the years after with how good sales were during 2020 and 2021. But I don't know if there's, other ones taking in and getting, the advantage of the losses for others. But there is definitely a big opportunity.
Which, of course, people do move in on. We do have this particular buyer for some of the Bay's locations, for instance, but already seeing signs of a struggle there. There's a sort of a pattern, Alex, and we see this in other sectors like restaurants where something has failed and there's somebody else who says, well, maybe I can make a go of this. How often is that a repeat failure in your view? There's a reason why it went down.
Yeah, exactly. I think you said it. Especially in this situation, I think on the smaller scale, a lot of companies could adapt and, make the changes necessary. But for a historic retailer that's been around for so many years, and for Ruby Lou to come and take over the existing leases and run a similar business model, or, what we think might be, it doesn't make sense to a lot. And I think that's why there is a tremendous pushback from a lot of these landlords saying, as much as she has the dollars and willing to take over the leases, we're just not so sure she's going to be here long term, because I don't think a lot of people believe in the business model.
All right, got to leave it there. Great to have you with us.
Thank you so much for having me. I appreciate it.
Alex Hennick is president of A.D. Hennick and Associates. Time for the takeaway and crying over unspilled milk. Once again, the U.S. has signaled clearly that it finds Canada's protection of its dairy market to be unfair, a trade irritant that the president seems personally irritated by. Given that our trade teams are probably holed up somewhere in Washington as we speak, a new Trump tweet about dairy is a sure sign that it's on the table in those talks. And that should not be surprising. Canada's system of supply management for dairy and poultry and eggs is one that many countries take issue with. It's one reason the UK walked away from negotiations of a post-Brexit agreement with Canada. There are many ways to support homegrown industry that wouldn't run afoul of our trading partners. So why does Canada insist on supply management? Because, make no mistake, we do insist. The recently passed Bill C-202 was a resurrected version of a law that died when Parliament was prorogued. In other words, it could have been left well enough alone. Instead, a new bill was rushed into law this summer. The law makes it illegal for our trade negotiators to put dairy on the table at all. And while you might think that's a bit short-sighted, tying the hands of all future trade negotiators, it's a law that had unanimous support in Parliament. How dairy became a sacred cow in Canada is more about politics than nutrition or support for business. It's no coincidence that the vast majority of the farms affected are in Quebec, and that Quebec often acts as kingmaker in Canadian elections. But beyond the political rationale, it's hard to find any other for this outdated policy. Is milk somehow special in a way that Canadian beef is not? When there's plenty of evidence that dairy products cost Canadian consumers more than they would if imports in this market looked more like imports in other ones. Maybe there's a way around Bill 202, which includes changing U.S. quotas for the Canadian market. If not, all Canadians will pay the price for this policy. My takeaway? Holding a whole trade deal hostage to one sliver of the economy feels illogical. But then we've been holding consumers hostage to that same sliver for decades. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.